Welcome to This Explainer. Have you ever stared at a massive wall of financial data and just wondered what on earth it's actually trying to tell you? Well, you are in the right place. Today, we're performing a complete financial autopsy on the industrial giant 3M. We're going to translate a dense, frankly overwhelming dashboard of metrics into a crystal clear picture of this company's true health. No hype, just strictly looking at the numbers to see what is really going on under the hood.
Okay, let's pull up our roadmap. Step 1, we'll look at 3M's current market snapshot. 2, valuation, comparing price versus fair value. 3, the growth engine problem. 4, profitability and returns. 5, dividends and debt levels. And finally, step 6, we'll deliver the final financial verdict. Let's dive in.
So, step 1, 3M's current market snapshot, or as I like to call it, the vitals.
At last check, 3M stock was sitting at exactly $146.22. That gives the company a total market capitalization of over $76 billion. That's a massive footprint, firmly planting it as a heavyweight in the industrial sector. But, a single price point only tells us where we are today. It doesn't show us the momentum behind it.
Zoom out just a little bit to recent performance and you start to see some bruising. The stock is actually down over 8% year-to-date and down over 3% in the last 30 days. Now, sure, there was a tiny 2% bump in the last 7 days, but the broader near-term trend is clearly facing some serious downward pressure. Moving to step 2, valuation. We're looking at price versus fair value to figure out the real price tag.
Now, this is where things get really interesting. If we run a discounted cash flow or DCF fair value model based on the company's financials, it comes in at just $101.58. That is a stark contrast to that $146 price tag we just looked at. DCF is basically a standard way to estimate what an investment is worth based on its expected future cash flows. And right now, the math is showing a major disconnect.
And that disconnect brilliantly highlights our first glaring issue. 3M currently has a negative margin of safety of nearly 44%. Now, in investing, your margin of safety is your cushion, right? It's the gap between the real intrinsic value of a business and the price you actually pay. A negative 44% margin means you are mathematically paying a massive premium over what the underlying business is actually worth today.
We see this exact same premium showing up in other metrics too. Right now, investors are willing to pay $28 for every $1 of 3M's earnings. That 28.17 PE ratio represents a whopping 71% premium compared to 3M's own 5-year historical average. And it's nearly a 63% premium over its 3-year average. So by historical standards, the price tag here is incredibly steep.
Step 3, the growth engine problem. So, if we're paying top dollar, the company must be growing rapidly, right? Let's check the engine.
Well, the data tells a very different and honestly a very concerning story. We're looking at the compound annual growth rates here. While revenue crept up a sluggish 2.28% over the last 3 years, the 5-year trend is actually negative, down over 5%. But it gets worse as we move down the income statement. Net income has contracted by 20% over 3 years and 13.5% over 5 years. Earnings per share, or EPS, is similarly dropping by double digits.
So what does this all mean for us? The absolutely crucial takeaway here is that you are paying top dollar, literally a 71% historical premium for a business whose core growth engine is actually shrinking. The bottom line profitability is actively contracting year over year, which makes that $146 price tag and high PE ratio incredibly difficult to justify based purely on the math.
Let's pivot to step 4, profitability and returns. Let's look at the engine's output.
We've got a fascinating tension here. At first glance, the return on equity looks absolutely stellar at over 85%. I mean, if you only looked at ROE, you'd think this was the most efficient company on earth. But look closer at the return on invested capital and return on assets. They are way more grounded, sitting at around 12.7% and 7.5% respectively.
Why does this massive gap matter? Because it's a classic telltale sign of heavy leverage. Return on equity measures profit against shareholder equity. If a company takes on a ton of debt to buy back shares or fund operations, their equity shrinks, which artificially inflates that ROE percentage. The fact that return on assets is only 7.5% confirms that the actual assets aren't generating 85% returns at all. The debt is just skewing the math. It's a great illusion right up until the bill comes due, which leads perfectly into our next vital check.
Step 5, dividends and debt levels. Let's talk about the payout.
Currently, 3M offers a 2.13% dividend yield. To maintain this, they're paying out over 56% of their total net income. But more importantly, look at the free cash flow payout ratio. It takes almost 78% of their free cash flow just to cover this dividend. When a company is spending almost 80% of its cash on dividends while its earnings are actively shrinking, there just isn't much left over for reinvesting or paying down liabilities. And notably, looking at the current dashboard, there are 0 consecutive yearly increases right now.
Now, remember that leverage we mentioned a minute ago? Well, here is the proof. 3M's debt-to-equity ratio is sitting at a very high 3.85. Basically, for every dollar of equity the company has, it carries nearly $4 of debt. In a high-interest rate environment, a highly leveraged balance sheet like that becomes a massive operational anchor.
To put that into perspective, this isn't just high for the markets, it's way high for 3M itself. This 3.85 ratio is a 66% increase compared to their own 5-year historical average of 2.31. The debt burden isn't just heavy right now, it is growing significantly, compounding those exact same issues we saw earlier with the shrinking net income.
Finally, step 6, the final financial verdict. Let's tie this whole thing together. 3M presents a really complex risk-to-reward scenario. On the surface, sure, you get a 2.13% yield and what looks like incredible historical return on equity. But when you pull back the curtain, you are absorbing a negative 44% margin of safety, which means you are paying a huge premium for a business whose bottom-line growth is actively shrinking by double digits, all while its debt burden is expanding rapidly.
The numbers don't lie. They just paint a picture of reality. Knowing these specific metrics, the 71% historical premium on the PE ratio, the shrinking growth, the ballooning debt, are you comfortable paying a premium right now just to capture a 2% dividend? People often see a famous blue-chip dividend as a completely safe harbor, but when the underlying ship is taking on water to pay it, you really have to ask yourself if it's truly a bargain. That is the ultimate question you have to answer.